세상을 바꿀 기술 인공지능의 열풍은 계속될 수 있을까요? 미국의 금리 인하가 미뤄지고 도널드 트럼프 대통령 취임 이후 쏟아지는 정책들 사이에서 투자자들은 어떤 전략을 가져가야 할까요? 한국 언론들과 만난 하워드 막스 오크트리 캐피털 회장의 인터뷰를 준비했습니다.
Okay, so a sea change is an expression that means a fundamental, significant, and potentially lasting change. This is not a normal short-term fluctuation. This is an alteration of the environment. And I wrote a memo in December of 22 entitled Sea Change, followed it up in mid-23 with further thoughts on sea change, in which I said, largely thanks to highly accommodative monetary policy, we went through an unusually easy time in a number of important regards over a prolonged period. But that time is over, and of course those are the key words. A lot of the money made by investors in the last 40 plus years was the result of a tailwind which the declining interest rates provided. Declining rates stimulate the economy, increase consumer demand, make businesses more profitable, make assets more valuable, reduce the cost of capital, and make financing more accessible, and make default and bankruptcy less likely. And all of these things characterized the financial environment over the period 1980 to 2020, and even since. I came up with the thesis in the fall of 22 in the course of my annual visit to Asia, in which I see a lot of airports. And so I was struck by the comparison between the moving walkway and at the airport and the declining interest rates. A walkway like this makes your progress easy, but you tend to overlook the contribution. You tend to think it's something you're doing yourself. Boy, I must be fit. While in fact, you're getting a lot of help from the walkway. And I think that's true of interest rates as well. The memo, Sea Change memo of December 22 focuses primarily on the period 09 through 21. At the beginning of 09, the Fed took the Fed funds rate to zero to fight the global financial crisis. At the end of 21, it gave up on inflation being transitory and started to hike interest rates to fight inflation. But between the beginning of 09 and the end of 21, which is a 13-year period, the Fed funds rate was zero most of the time, and I believe averaged about 0.5%. And as a result, we had the longest economic recovery in U.S. history and the longest bull market in the S&P in U.S. history, both exceeding 10 years. Now, it's important to notice that in addition to the benefits derived from low interest rates, there are also problematic aspects. Reduces the perceived opportunity cost. You know, if you have to take your money out of the bank to buy something, but you're not getting any money in the bank, you think it's free. This encourages risk-taking, which leads to potentially unwise investments. If the rate of interest on very safe investments like treasuries is extremely low, people will go out the risk curve and do riskier things in order to make what they consider a decent return. This risk-taking attitude and the low cost of credit encourages deals to be financed readily and cheaply, and you see a lot of leverage being put on the system. It encourages the greater use of leverage, and that increases the fragility of the system and of the individual transactions, and it induces optimistic behavior that lays the groundwork for the next crisis. And if you think in terms of cycles, you have to realize that each event leads to the subsequent event. There was a good book that came out, I guess it was in the fall of 23, called The Price of Time by Edward Chancellor, an English financial historian. What is the price of time? Interest. I lend you my money for a period of time. You pay me rent in the form of interest. And Chancellor quoted John Mills, an 1865 English banker, as saying that as a rule, panics do not destroy capital, they merely reveal the extent to which it has previously been destroyed by its betrayal into hopelessly unproductive work. So in other words, in periods of low interest rates, people do risky things. The book uses the term malinvestment, which I like. And this malinvestment actually destroys the capital, not at that time, but the destruction becomes obvious when we go into a crisis and the investments fail. And this corresponds to what Warren Buffett said many years ago. You don't find out who's swimming naked until the tide goes out. that is when the malinvestment is disclosed. And there are reasons why I don't think interest rates are going to be ultra low or constantly declining. I think that keeping monetary policy stimulative comes with risk. I think the Fed has to maintain its credibility after having mischaracterized inflation as transitory. It can't be jumping around loose, tight, loose, tight. The Fed needs interest rates to be high enough so that if there's a recession, they can cut the rates and stimulate. And when the rates are 0 or a half or 1, there's no room for significant rate cuts. The Fed, I hope, will decide to maintain a neutral interest rate, which is neither stimulative nor restrictive. And I'd like to see natural interest rates, which are interest rates which are set in negotiations between borrowers and lenders rather than by somebody sitting in Washington. So for these reasons and others, and simply because there isn't much room for declines, I don't think we're going to see a repeat of this long period of declining interest rates. In fact, I said in further thoughts on sea change that the Fed funds rate, which was then 5.25, 5.5, would go to, let's say, roughly 3.5 and stay there. And, now it's 4.5, and right now it's staying there. And I think that the outlook does not call for many interest rate cuts or big ones. Now, people say to me at this point, okay, so you're talking about higher for longer. And the truth is, today's rates are not high. Here's a chart of the Fed funds rate over the last 70 years, and the yellow line shows the average, which is just under 5%, and today we're just under 5%. So today's interest rate is quite normal in the span of history. It happens to be high relative to the last 20 years, but in general, not high. As I said, I think rates will go down to the 3s and stay there, but well above the norm of 09 to 21. So Einstein defined insanity as doing the same thing over and over again and expecting a different result. I think it's equally insane to do the same thing in a different environment and expect the same result. I think that investors will be in a different environment in the coming years, and they should not expect the things that worked best in the declining interest rate environment to work best in the years ahead. That's the basic message. And I wrote a memo November about asset allocation, and this was the basic theme of that. So, the Paul Samuelson, who is the economist who wrote the textbook on economics that I used in college, and many of us have used, says, when events change, I change my mind. What do you do? I think that the investment environment has changed. What will each person do about it? That's the key question. Or to invert the question, to play devil's advocate, what could be the reason for not allocating money away from ownership assets and into credit? So that's my basic message.
Given the U.S. President Donald Trump's immigration and the South Korean President Yoon Suk-yeol's martial law crisis, what adjustments do you anticipate making to Oaktree Capital's investment strategy?
I'm not surprised that you would ask about the recent political developments in both our countries. My opinion of Korea has always been very favorable. And as I say, I've been visiting for close to 15 years, and I have clients there and also good friends outside of business. And I have great respect for Korea. It's a high-functioning country, as far as I can tell. Very educated people, very strong work ethic, very efficient and organized. We have been investors in Korea equities for a long time, and are continue to be and continue to look for bargains. Of course, the Korean stock market has not performed favorably lately, even before the political upheaval. We style ourselves as contrarians and bargain hunters, and I think that means that if we continue to search for good performing countries and when we can buy their stocks at depressed prices, we're eager to do so. And we'll continue to look at Korea in that regard. And we certainly don't have the slightest objection to investing in Korea. And we believe that the Korean stock exchange and business community are attempting to move into a period of investor consciousness, creating value for stockholders, and so forth. So I view that as a favorable development. But the other thing is, in our country, also, I believe the outlook is more uncertain. I think that newly installed President Trump, his administration is now 4 days old. I think the way to describe it is thinks outside the box. And he considers things and will do things that other people haven't considered or haven't done. So the range of possible outcomes doesn't look like this. It looks like this. And many, many more things are possible than usual, and things that in the past we might have considered tail events or not possible are now possible. And the other thing to bear in mind is, in the past, if a president said something, you tended to think, well, that's what he's going to do. This president is more tactical and more of a negotiator. The things he says he'll do are maybe things that he will do, or maybe they're negotiating points, or maybe he's bluffing. I don't remember ever listening to a president in the course of my life and saying, oh, that's a bluff. He's just saying that for public consumption, or just saying that for the person on the other side of the bargaining table. I think when Trump says something, we don't know whether he really intends to do it. My own guess is that he is highly focused on accomplishment and successful negotiation and problem solving, and his tendency will be to confront the situation, maybe threaten a given action, extract a concession, declare victory. I don't have any inside information, but that's kind of more like the kind of pattern I expect to see over the course of his administration. But the only thing I would say, I say often in my memos, and I would apply it doubly to President Trump, we'll see.
And my question is, in your letter to customer, you referred about the possibility of a bubble in New York stock market, and yesterday stock market hit an all-time high. So are you maintaining your thought about bubble? And my second question is there any possibility that Fed increase the interest rate again? And my third question is, what, in your opinion, what is the biggest risk in U.S. economy in Trump 2?
You notice in the memo, I didn't say we're in a bubble. And I said that some of the key ingredients in a bubble are missing at the present time. Prices are somewhat high. The prices of the Magnificent Seven are somewhat high. The market has performed unusually well in the last 2 years. According to J.P. Morgan, there were only four periods in history when the S&P was up more than 20% 2 years in a row, and this is now the fifth. Usually it does not rise in the next 2 years, and usually declines. We'll see. And you remember there's a chart in there which shows the performance. If you buy the S&P at a given PE ratio, historically, what has the return been over the next 10 years? And in every case, it showed that if you bought the S&P at today's PE ratio, which is roughly 22, your return over the next 10 years was between minus 2% and 2% a year. Let's say minimal return if you bought it at this price. And of course, that's a very important fact. We don't ever know what the future holds. The optimist always theorizes that the future will be different from the past. If you're thinking about a departure from history, you have to understand that the odds may be against that being correct. And then the other thing is that in the memo I pointed out that, in my opinion, the behavioral or psychological aspects of a bubble are missing. A bubble is not a period of high prices. That's called a bull market. A bubble is a period of temporary insanity, when people go crazy over a given asset class, don't see any flaws, only see unlimited potential. Potential is usually not unlimited, are consumed by the fear that if they don't buy it, it'll go up and they'll make themselves sick. They'll have to live with all their friends and competitors who are making money they're not making, which is a very strong force, envy and regret. So those things I don't think are present to the same extent. And the rallying cry in the bubble is, there's no price too high. The internet will change the world, 1999, and there's no price too high. Well, the internet certainly changed the world, but if you paid the 1999 prices, you lost, in most of the internet and e-commerce companies, you lost all your money. So the point is that in a bubble, people stop thinking rationally about the fair price. They're consumed by FOMO. They can't imagine any price which is too high. And then, of course, the bubble usually surrounds something which is new, for which there's no precedent, which would tend to limit optimism. And I just don't think those things are present today. I think people are optimistic. I think the market is strong. It has done well. But I'm not saying get out of the market. If you are risk averse, if you're a worrier, if you're a person who's close to retirement age and you need your principal or something like that, then you might dial down the aggressiveness of your portfolio. You might somewhat increase your stance. But I'm not ringing the alarm bell and saying, it's time to get out. So if you remember this graph, think about this. This kind of suggests the historical relationship. The S&P has averaged a 10% return, 10% a year for the last century. Of course, credit investments, fixed income investments, have returned less because they're safer. But in early November, I think it was, Goldman Sachs said they thought that the S&P would return 3% a year over the coming decade. The JP Morgan chart that I showed in my memo implies 2% at best. So we're not talking about 10%. Oh, well, I'll draw you a picture. S&P with a return of 10, and let's say the history of the last 13 years, credit down here, let's say high yield bonds with a yield of, let's say, 5. That's history. Now, let's talk about today. Now, according to Goldman or Morgan, the prospective return on the S&P is low single digits. Let's say, now this is S&P today, 3, 4, 5, maybe 2. Okay? And then, now you look at high yield bonds today, and this thing has shifted over here, and high yield bonds this morning averaged 7.2. There's a bias and a tendency to say, well, stocks do better than bonds. But if you look at it critically today, the evidence suggests that the S&P in the next 10 years will not have a typically high return, that it'll be mid to low single digits. And the return on high yield bonds today is more than that. It's in the 7s. So the expectation that stocks will outperform high yield bonds in the coming years is based on a habit of thinking, not the current evidence. So I think this is very important. And if somebody is risk averse and wants to take action, it would not be unreasonable at all to shift money from the S&P to credit investments. The Fed would only increase rates. First of all, interest rates today are higher than they were expected to be today. Remember, at the end of 23, the consensus was there will be 6 interest rate cuts in 24. If interest rates were then 5.25, 5.5, and if you had 6 quarter-point interest rate cuts, interest rates today would be 3 3/4, 4. Well, they're 50 basis points higher. Interest rates are already higher than was projected. by the optimists. The only reason that the Fed would raise interest rates would be, I think, if inflation began rising. Inflation is in the high 2s now, very close to 3. The Fed wants it to be 2. I think the last 100 basis points of inflation reduction will be difficult. There are certain trends underway in the world which are pro-inflation. A decline in globalization is inflationary. The deficits that our country chronically runs are inflationary because what it means is the government takes a little money out of the economy through taxes, but it puts back more through its spending. It spends more than it takes in. That's inflationary. That adds liquidity to the economy. Having said that, I'm not an economist. I don't believe in economic forecasts, including my own. I don't think it's highly likely that inflation will resume rising. It may not come down very readily, which means that interest rates may not be cut much more. But I don't think I don't think there's any reason to think inflation is going to go up. Thus, I don't think there's any reason to expect that interest rates will rise from here. The worst thing in our system is the deficits. It's unfortunate that our government leaders don't have the discipline to live within their means, will not restrain their spending to fit within our income, or will not increase taxes to support the spending. I think the U.S. acts like somebody who has a credit card which has an unlimited balance and never gets a bill. If I gave you a credit card, Oaktree credit card, which has no limit and no bill, the only rational behavior would be to buy everything you could think of. But then you have to say, well, just a minute, is it going to stay that way forever? Will I never get a bill? It's not rational to think we'll never get a bill, so we shouldn't behave that way. It's hard to figure out what's going to make the bill come. If it ever comes, it'll be problematic. And that's the biggest single problem.
I saw in your memo, you said that China is still attractive market. Do you maintain the view in Trump administration, and what sector do you pay attention to?
I believe in economic rationality, and I believe that the economy and economic progress is very important to China, to keep it on the track, to keep the citizens happy, to keep President Xi in power. I think it's very important to him to have economic success. And I think that will tend, ideology aside, I think that will tend to keep China on a constructive track. And the other thing is, I think that Donald Trump, with his unpredictability, probably feels like more of a threat to China than Joe Biden did, because Joe Biden appeared weak, and recent administrations appear that they would threaten certain actions but never take it. And I don't think anybody would make any assumption that Trump wouldn't take action if provoked. So I personally think that this will bring China to the bargaining table. I'm not going to bet on this. I don't bet on this stuff, I tell you. But if I had to make a bet, I would say that sometime in the next 6 months, there will be an announcement of progress in the U.S.-China relationship, and Trump will get his announcement of victory that he so enjoys, and tensions will decline. We all have to know our biases. My biases is, we all, I think, tend to predict that the things that will happen will be the things we want to happen. I want to see peace. I want to see progress in our relationship. I want to see a reduction in tension. I believe that President Trump has the potential to produce it. Look, China needs roughly 5% GDP growth every year. It grew for 30 years, it grew at 10% a year, which was a miracle. Of course, it grew on moving people from the farms to the cities and into manufacturing, and also on ultra stimulus, monetary stimulus and provision of capital for building. Now it's trying to transition to less stimulus and 5% growth. And it needs 5 to accomplish its goals. And 5 is still a very high rate of growth that no other country produces on a secular basis. I believe that China can't get 5% GDP growth based on demand from domestic sources plus Iran, China, Korea, North Korea, and Russia. It needs the rest of the world to give it the demand that it needs to grow at 5%. And so I think it's not going to antagonize the rest of the world. That's my own bias, my optimistic bias.
After reading your recent memo, my impression was you somewhat optimistic because you mentioned Elon Musk and he can make some progress and aggressive business-like approach could produce benefit. You mentioned. My question is, in a worst scenario, how do you think that things going on if Elon Musk failed to reduce the cost and if Donald Trump tried to reduce tax and try to spend more? How do you think about that scenario and what could make that happen?
Well, I think that it will be hard for Elon Musk to greatly reduce the cost of government. The vast majority of our annual expenditure goes for defense. Can't cut that much. Can't pay soldiers less without weakening our country. Entitlements, Medicare, Medicaid, Social Security, people rely on those things. And, you know, my generation, the baby boomers born after World War II is a very large generation, disproportionate to the other generations, and now old and needing financial support and demanding it, and by the way, a lot of voters, so no politician wants to antagonize the baby boom, and living a long time. Then number 3 is interest. So like 3/4 or 80% of the budget goes for defense, interest, and entitlements, and very hard to cut any of those. So it's just, I would not be optimistic. I think that at the margin, a business-like approach can make government run a little better. And as I said in the memo, I understand that only a third of all federal workers never go into the office. My guess is they're not putting in a full work week, all of them. But I don't think that they'll make a radical change in the budget. And Trump would probably like to cut taxes because that makes people happy, and he wants to be well thought of and perpetuate his movement in power. The reasonable expectation is we'll continue to have deficits and they'll continue to grow. The greatest hope would be that the deficits will start growing slower than GDP, not faster. I think it's very hard to be optimistic on that subject, and so I said it could be helpful, but don't characterize that as a prediction.
How many will Fed to cut the interest rates this year?
You know, I don't make forecasts, so I'm not going to give you any numbers. But I think that over the balance of this year, interest rates there are likely to be a couple of interest rate cuts, and interest rates are likely to come down a little. But, you know, in further thoughts on sea change, I thought that the rate, Fed funds rate would be 3 to 3.5 at the end of the reduction process. I don't think we're going to get there this year.
I'd like to listen about your opinion about cryptocurrency, from Bitcoin to Trump coin, Melania coin, things like that.
It is my firm belief that unlike companies, stocks, bonds, properties, cryptocurrencies do not produce any income. And because they don't produce income, you can't put a value on it. You can't say the intrinsic value of a Bitcoin is this. These are speculative currencies, speculative investments, because there is no intrinsic value. And so we try, you know, we have 1,200 people at Oaktree who are engaged in a process of investing analytically. What that means is, analytically means you figure out the value of something and you see if you can buy it for less. And you, based on you project the value in the future, and you try to figure out whether if you bought it at today's price, that would give you an attractive return. That's analytical investing. There's no such thing with Bitcoin. You can't say what the intrinsic value is today. You can't say what the intrinsic value will be in 10 years. That notion doesn't exist. And so you buy it because you think that in the future you'll be able to sell it to somebody who will pay you more. We don't engage in that kind of investing because it can't be done on an analytical basis. Of course, the people who bought Bitcoin at 1,000 in 2017 or 4,000 in 2020, it's now 100,000. So at the moment, they look smart, and the people who didn't buy it look dumb. You know, if you're going to be professional and serious about investing, you have to say, well, these are the things I will do because I think the world works this way, and these are things I'm not going to do because they don't comport with my view of how the world works, but I acknowledge that you might be able to make some money doing it. But, you know, I can't bring myself to do it. Thank you for being here with us today.